Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over HIMS and HERS stock, in which they have their earnings report in a few days on August 4th, and I'm going to be going over why I think this could change everything for HIMS and HERS because of some recent news from HIMS and HERS, and also I'm going to be getting into the financial health of the company, and then using my intrinsic value calculator to determine the fair value price I think HIMS and HERS should be at and where I'd be buying the stock. And by the way, I do own some shares of this company. I have been trimming my shares just a little bit, but let's get into HIMS and HERS stock. And taking a look at HIMS and HERS stock, we can see looking at the year-to-date performance, this company is on a roll, up almost 150%. This is almost 10 years in the stock market returns, and this has just happened in less than a year. So this company is really growing the stock price at a fast rate, and it's just been soaring. And I started actually buying this company, I think it was like in this area right here, and I kept dollar cost averaging all the way down to here. So right now I have been trimming my shares. I trimmed some around here, and also a few here. So I am trimming some of my shares. I still definitely have some shares left. Don't worry about that. I do have a small position though. It's one of my smallest positions in my portfolio, but I still have a lot of shares, and I'm up nearly 150% on this company. So with that being said, let's get into what HIMS and HERS does as a business. And as we can see here, HIMS and HERS is a telehealth company. So this company is online basically, and they're direct to consumer company in a subscription based model where they can allow consumers to connect with licensed healthcare professionals online and then also get prescriptions. So basically this company is a telehealth company where you can go online, connect with a doctor or any healthcare professional, and then talk to a doctor anytime you want and see what prescriptions you can get, and you can subscribe to the business to get more subscriptions, in which the company also produces their own drugs. HIMS and HERS is basically saying that they're trying to help healthcare out for making it more accessible, affordable, and convenient by leveraging technology to connect with patients. So I really like this about this company, and one thing I very like about this company, which I am saying I really like it, the subscription-based model. If a company has a subscription-based model, that means they're going to get recurring revenue, and if they continue to grow the subscribers, this company will compound over time and just make more and more. In which I really like this about this company because there's not many healthcare companies out there that have recurring revenue like this. While there's health insurance companies, which you can say is recurring revenue and subscription-based model, which it is, this isn't a healthcare insurance company. This is basically just a healthcare company providing drugs, and I really like that about HIMS and HERS. But getting into HIMS and HERS, we can see HIMS and HERS actually had a partnership with Novo Nordisk. They had a partnership with Novo Nordisk, which this company is a very big, one of the biggest drug producing companies in the entire world, where they produce mainly weight loss drugs and diabetes drugs. So this company had a partnership with HIMS and HERS, but the collaboration was short-lived. As we can see here, they just recently terminated the agreement in June 2025, where the stock tanked, I think it was almost 30% in one day because of the termination of the deal, in which Novo Nordisk accused HIMS and HERS of deceptive promotion and selling illegitimate knockoff versions of Wegovy. So they believed that HIMS and HERS was knocking off Novo Nordisk and selling fake versions of Wegovy, in which they believed the compounded drugs were manufactured by foreign suppliers in China, and they have not been authorized or inspected by the FDA, raising significant patient safety concerns. However, HIMS and HERS did strike back, saying that the Novo Nordisk commercial team had pressured the company to control clinical standards and steer patients to Wegovy, regardless of whether it was clinically best for patients. So HIMS and HERS is basically saying that Novo Nordisk was just trying to make as much money, even if it was bad for their patients. So there's a pretty big dispute between these two companies. Who knows which one is right? But nonetheless, the termination is over, so it's over with. So getting into how this could impact HIMS and HERS, we can see they could lose credibility and direct access because they did end a termination with the major branded drug company like Novo Nordisk. Ending a partnership with a big drug company like this could potentially hurt the company's credibility and also the market volatility, which I said the stock dropped over 30% in one day. Also, continued legal and regulatory risk. The termination of this deal gives ongoing debate and potential for a legal battle over compounded GLP-1 drugs, which is basically weight loss drugs. And it's basically, there is a loophole for HIMS and HERS to be selling these drugs because basically the FDA says if these drugs are in a shortage, they can technically compound the drugs and sell them themselves, but it is ongoing debate on whether these weight loss drugs are in a shortage, in which Novo Nordisk doesn't believe so, but HIMS and HERS does, and also the impact on revenue. While branded weight loss drugs like Wegovy were a part of the company's offerings, compounded medications accounted for a larger portion of its weight loss sales. So, however, the loss of the partnership could hurt HIMS and HERS beyond direct sales by reducing consumer traffic and the overall appeal of its weight loss platform. I would like to add that the weight loss segment of this company takes up 20%, but the Wegovy isn't all of the weight loss of HIMS and HERS. They offer a lot of other weight loss drugs, not just Wegovy, so to be fair, I don't think that big drop was warranted. I think, yes, it could affect them, but I don't think it's going to affect them as much as people think. And taking a look at HIMS and HERS subscriber growth, we can see that it is increasing every single quarter at a pretty fast rate. Over 50% CAGR, which means compounded annual growth rate is over 50%. So this is very fast subscriber growth from HIMS and HERS, and you really like to see this with a company like HIMS and HERS because it's a subscription-based model. But taking a look at HIMS and HERS' latest quarter's earnings and their upcoming quarter's earnings, I like to point out that the company did say that they're expecting their revenue to hit $2.3 to $2.4 billion, roughly 59% growth on the low end. So this company is expected to grow at a very fast rate still, very fast growing company. And taking a look at their latest quarter's earnings, they did report EPS normalized actual earnings per share of 28 cents, beating by 6 cents from analysts. Also, the revenue was $586 million, beating by $47 million. So this company beat by a good margin on their last quarter. But looking at the upcoming quarter, we can see analysts expect them to report 23 cents in EPS normalized estimates and GAAP estimates of 16 cents. So taking a look at the comparison, they're expecting a decent decrease in their earnings per share. While it's not much, it's still somewhat of a decrease. Also, the revenue is expected to decrease by about 30 million over this quarter. So I think this could actually still be an increase. Me personally, I think this company is going to beat, and actually I think this number could be 600 million, and also the EPS, I think it's going to come in at about 22 cents. I think this company is going to get 22 cents in EPS GAAP earnings, and then also I think the revenue is going to be 600 million, right around there. So I'm going to be coming back to this, see if I'm correct, but nonetheless, taking a look at what the earnings per share has been over the past few years, we can see just continuously increasing over time. And as we can see, this company was not profitable until 2024, basically. They just recently started to make money in 2024, so this is pretty decent. This is pretty good for the company to see that it is starting to get profitable, and I really like that about HIMS and HERS. But taking a look at what analysts expect, they expect the earnings per share to be right about here for HIMS and HERS. So a slight decrease quarter over quarter, but don't worry, year over year, the earnings per share, if they do what they analysts expect them at 16 cents, this is still a very fast growth, where last year during this quarter, they were at 6 cents. So with that being said, they're growing at nearly 250% still. So it's going to be a 250% earnings per share growth rate. And as we can see, as they turn profitable, it's been growing at over 300%. So this company is a very fast growing company, especially with the earnings per share as they become profitable. Now taking a look at the revenue. The revenue just continually increasing over time at fast rates. As we can see here, the average annual revenue growth rate is probably 50 to 60% here, and it's up to 100%. It just keeps reaccelerating growth. As we saw a pretty big dip right here in 2024, but since then it's just increased even greater. So this company is growing at a very fast rate. But taking a look at where analysts expect the revenue to be, we can see they actually expect another slight decrease to right about here. So with that being said, do I think this is accurate? I truly believe they can still get up to about here, 600 million. So with that being said, analysts still expect revenue and earnings per share to be slightly lower quarter over quarter. But taking a look at HIMS and HERS, what the bulls and bears say about this company. They say that international growth could be meaningful for HIMS, and also the sales growth is likely coming in above Street's expectations, which I agree with. But there is some good bear statements. With core sales growth declined 4%, driven by rising competition, seasonality, and shifting of marketing dollars. Also, regulatory pressure with the FDA trying to crack down on their GLP-1s, which is their weight loss drugs, and then the sales is expected to decelerate over the year over year. So that is what I've been saying. They are expecting to decelerate in growth rate, but they're still going to be increasing at a very fast rate. Don't get me wrong. And this is what I think is going to happen on August 4th and what to expect for the company. I think the earnings and revenue will likely beat by a good margin. I think they're going to report $600 million in revenue, and then their earnings per share, I'm thinking 22 cents. So I'm actually being a little bit more bullish on this company, and I really believe this is what's going to happen with HIMS and HERS. I also believe analysts are underestimating growth this quarter due to the termination of the Novo Nordisk deal. People still want cheaper drugs, so they will turn to HIMS and HERS, in which I truly believe that just because the termination of the deal happened, I think analysts are really underestimating the growth still with this company. They still expect this company to decrease. I think that's just wrong. I think they're going to increase quarter over quarter still, but with the Novo Nordisk deal, it gives analysts more uncertainty of what their revenue and earnings per share will be, and that's why they're expecting a slight decrease. However, I still say we will see a slight slowdown in growth because of the removal of Wegovy. I still think it's definitely a big deal for HIMS and HERS, but I think the removal of Wegovy isn't as big of a deal as others think. So with that being said, I think earnings and revenue will beat, and I think that the revenue and earnings per share will still grow quarter over quarter, but I do expect a big slowdown in that growth rate. Now take a look at the financial health of HIMS and HERS. We can see we have 5 out of the 7 metrics that I like to look at. We have the P ratio greater than 0, meaning this company is profitable. But I would like to add, compared to the stock market at a 25 PE ratio, this is pretty high. But I would like to also add that the revenue growth rate at 78%, that means they're growing about 5 times faster than the normal S&P 500 company, but their valuation is only 4 times. So compared to the S&P 500, they're 4 times the P ratio, but 5 times the revenue growth rate. So in reality, this company could still be undervalued compared to that, but the one thing I don't like is the forward PE ratio. And it's not necessarily that it's so high. I do like to see it under 30, meaning you're paying only $30 for $1 of future earnings per share. But the biggest reason I don't like this is because analysts expect the earnings per share to actually decrease in the next year because the forward PE ratio is higher than the normal PE ratio, which normally we want to see the trailing PE ratio, which is this number here, more than the forward PE ratio. But nonetheless, I still think analysts might be wrong here. Also, the earnings per share growth is positive, meaning it went from negative to positive net income, and this is growing at 300% over the past year, so this is definitely faster than 5%. But another big worry with me is the shares outstanding. You might see this number and say, wow, 117% each year, that is insane dilution. I would like to say, like, if you looked at the chart of the shares outstanding, you would see this a big jump in shares outstanding decrease right here, but then over the past few years it goes like this. So when they went public with an acquisition, they didn't go public with an IPO, they did an acquisition. So with that being said, they diluted a lot during that time. They diluted 400% that year or more. Right now, they're only diluting by about 5% each year, so it's not too bad when you look at that. So with that being said, this is an overinflated number, and they're starting to not really dilute investors too much. Debt to equity ratio less than 50. This means that the company has about 0.1 times the amount of debt compared to their equity. So they have very little debt compared to their equity, and I really like that about this company. And analysts still expect this company to grow at a very fast rate, about 36% over the next 5 years. So this is an annual estimate, not 36% in the next 5 years. 36% each year over the next 5 years. So analysts still expect this company to be growing fast, but I would like to add it does show deceleration in the growth rate, but still it's very fast. So with that being said, I'm going to be taking a look at my intrinsic value calculator, in which I have to use future annual revenue growth rate assumptions and also use other assumptions of the future of what I think they can do. So first I have to do the future annual revenue growth rate for the next 5 years, in which analysts expect them to grow at 36% and I believe this company could grow at about that rate. I think that the fair revenue growth rate could be 30% over the next 5 years, which would give them about $6.6 billion in revenue, and I think that's actually pretty fair. Now for the future profit margin. Right now, they're at about a 10% profit margin, in which I think this company will start to increase even more. They were increasing at a pretty decent rate because, as we saw with the net income going to profitability, the profit margin is also increasing over time, and I think that we can get to see this at about a 13% net profit margin. It's been growing at a pretty decent rate, so I'm going to be a little bit more bullish from what today is, in which I think that it could be happening, in which I see a net income of $860 million in the next 5 years. Now for the future P/E ratio. Like I said earlier, this company is trading at about 4 times the normal average of the stock market. Do I think that they deserve this in the future? Probably not, especially if they grow at a 30% rate. The market's growing at about 10 to 15% with their revenue, and right now they're trading at about a 25 PE ratio. I think that's too high for the market, me personally. I think a fair PE ratio for the stock market should be about 20, and this company is expected to grow about 30%. While I do think that this company could be seeing a little more challenges in the future, I think they should be trading at about a 30 to 35 PE ratio because of this fast growth rate. So I'm actually going to meet right in the middle at about a 32.5 PE ratio, which I get a future market cap of almost 28 billion. Now for the shares outstanding. So I think they're going to be growing these shares outstanding at about 5% each year, which they've been doing basically for the past 3 years. I think they're going to continue to dilute shareholders unless they start to buy back shares, which I highly doubt, especially for this type of company that is just starting to turn profitable. And with that being said, with the current price at about $62, I see us getting a total annualized return of about 9.6%. So I see still decent returns at this price, but me personally, I'm definitely not adding to my position. I'm going to wait for a lower price, in which I want this company to probably get to $50 or so to be adding to my position. So if it gets to 50, I probably will be adding a little bit more shares. But taking a look where I'm at about $25. I think I can make about 31% each year over the next 5 years, in which I'm up 150% right now. So thank you guys for watching this video on HIMS and HERS. Please comment down below what you thought about this video. Please like and subscribe, and thank you guys for watching. See ya.